What's going on, guys? Welcome back to Engineered Financial, where you learn the things that schools just didn't teach you. So today I'm going to break down the stock market for you guys, which is one of the biggest ways to invest. And what I'm hoping to do is give a foundation for future videos where we could do a deeper dive. So what is the stock market? Well, simply put, it's kind of like an auction. It's where people buy, sell, and trade throughout the day. So what's for sale, you ask? Well, you can purchase stock or shares of a company directly or through blended funds. And what that does is it gives you a percentage ownership of that company. And where you make your profit is when share prices go up due to company or economic growth. And the share price is determined by economic reports, so companies' quarterly reports or annual reports. Also comes from news and political events, just to name a few. So how do you invest in these companies? Well, what you're going to do is open up an account. Now, there's two different types of accounts. There's retirement accounts and individual accounts. The three types of accounts I'm going to cover today are traditional IRAs or traditional individual retirement account, Roth IRA, also known as Roth individual retirement account, and a brokerage account. So in a traditional IRA, what you do is you invest money pre-tax. So it's taken out of your paycheck before you receive it. And this money grows over time, and you don't pay taxes on it until you take money out later in life. And so the most common example of this would be a 401k. That's generally offered by companies. If you work for a school, university, or a nonprofit, they're 401as. They're the exact same thing. They're handled a little bit differently, but it's the same concept. It's a pre-tax investment, but you pay no taxes on this until you take that money out. You will pay fees, however, if you take money out before the age of 59 and a half. So it is a retirement account, and it is specifically used for retirement. A lot of companies will match a percentage of your contributions, so something you definitely need to look into if you're not sure of yet. But a company could, for instance, say they'll match up to 5%. So if 5% of your pre-tax paycheck was $3,000, then at the end of the year, your company will also put $3,000 into your account, which is free money. A Roth IRA is a post-tax retirement account, and that's where you invest money after taxes have been taken out of your paycheck. This is still a retirement account, so you will face fees if you withdraw money before the age of 59 and a half, but the money that you invest grows tax-free. So when you take money out after 59 and a half, you don't have to pay taxes on the growth. Now, the thing is, you can only invest $5,500 a year as of 2018, but that's something that has gone up over time, and so 10 years from now, maybe you can invest $6,500. But it's a great way to invest money and let it grow tax-free. A brokerage account is an individual account that is also done post-tax. You do have to pay taxes on your earnings, but you can withdraw that money at any time. So let's say I opened up an account for $5,000. It stayed in that account for a year. I needed to purchase a new car, and I needed $3,000 to be able to do that. I can withdraw the $3,000 without penalty out of that account. And if you don't have time to manage that account or just don't care to, you can always hire somebody who will manage what you invest your money into. They will charge fees, but it is very helpful for somebody who just doesn't understand or doesn't want to do their own investments. Or you can do the research yourself and make your own investments in the account. Now let's talk about what you can invest in these accounts. So first, let's talk about individual stocks. So as I mentioned earlier, you can purchase a piece or part ownership or share, all the same thing, of a specific company. And as that company grows, your share prices and ultimately your profit will increase, or the company could go under and you could lose your money. But it's very high risk, high reward. It's potentially where you can get the greatest return, but also potentially where you can get the greatest losses. And some companies, generally the ones that are doing pretty well, will pay out dividends. And what dividends are is a piece of the profit that is given to the investors. These are often paid quarterly. Sometimes they can be annually, but what it is it's paid out per share. So let's say that the company is going to give out a dividend of 25 cents per share, and you own 100 shares of that company. Well, then you will have received $25 just off of dividend. And dividends aren't guaranteed. Just because a company has paid dividends doesn't mean they will in the future. But if a company is paying dividends, then generally they're pretty confident in their ability to grow. They're already making pretty good profit, and so oftentimes you can expect them to continue to pay dividends in the future. Next, let's talk about bonds. So what bonds are is basically a loan to the company or government that will give you an anticipated return. So an example would be a corporate bond with a face value of $1,000 and a coupon of 5% paid annually. Basically, what that would come down to is you would receive $50 annually until the end of the maturity of that bond. And it could be short term, it could be 3 years, it could be long term, 10 years or 20 years. And at the end of maturity, you'll receive your initial investment back. The kicker is bond rates can change, and so you don't have to hold on to that bond for its full maturity, but that's for a future video because that can get a little hairy. Now let's talk about diversified investments, and what that is a long-term investing strategy in which you own little chunks of a ton of companies. So first off, we got mutual funds, and what that is a group of companies blended together into one fund, which has been set up by a fund manager. And there are literally like thousands of types, but some of the categories would be a money market fund. So it could have government bonds and treasuries, different ones mixed into one fund. You could have specialty funds, and so it'd be energy company based or maybe tech company based, or it could be a balanced fund, which could have different companies from all aspects of the industries. So the goal of these funds ultimately is to beat out the stock market growth as a whole. Oftentimes this is not done. It typically falls short over the short term and definitely falls short over the long term. A lot of times they're marketed as huge successes, and some of them are. But what it doesn't take into account is the fees that are charged by the fund manager for managing that fund. And so you may have the stock market may have gone up 10% that year, and maybe the mutual fund went up 11%, but the fund manager has 2% of fees, and so you really didn't make 11%, you made 9%. And so it underperforms the stock market more often than not. Next are ETFs, or exchange traded funds, and these are somewhat new, not brand new, but in comparison to the stock market, they're relatively new. And what they are is they're blended companies into one fund, much like a mutual fund, but instead of being traded before or after the market, when the market's closed, it's actually much like an individual stock where prices can go up and down throughout the day and can be bought or traded throughout the day. And as I mentioned, mutual funds and ETFs, these are long-term investments, and so you generally will see steady increase over time. Obviously, as our economy grows, you'll see these funds, worth grow. So now finally, let's talk about index funds, which are a type of mutual or ETF, but they're not actively managed, and so generally your fees are low. They can be as low as 0.1 or up to 0.5%. And so what these funds allow you to do is to invest in the stock market as a whole or major components of it. One example would be the S&P 500, which are 500 companies blended into one fund, and these companies actually make up about 85% of the total stock market. There's also the Russell 2000, which are 2,000 smaller companies blended into one fund. But what these index funds allow you to do is to basically invest in the stock market as a whole or a majority of it, and you reap the benefits of our economy's growth over time. And so For example, the S&P 500 has averaged a 8% increase over the last 40 years. And I personally think index funds is the way to go just because it's passive investing. There's not fees associated to it because the top 500 companies are generally going to remain the top 500 companies. Might have one or two that get traded out here or there, but you're not going to get a lot of extra fees hit to you because, you know, a fund manager is actively trading those companies in or out of that fund. And ultimately you reap the benefits of, you know, getting that stock market growth over time. And so that's why I think personally it's the best way to invest over the long term. Well, that's been a breakdown of the stock market. I hope you guys enjoyed that video. If you have any questions or have any comments, please comment down below, like, subscribe. I'm looking to grow this channel, and we'll see you next time.